A massive geopolitical shock is sending tremors all across the globe. And if you're an investor in India, well, you're probably feeling it right now. This week is shaping up to be one of the most volatile we've seen in a long time. So in this explainer, we're going to break down exactly what's happening and, more importantly, what it all means for your investments. And wow, this image really captures the mood perfectly, doesn't it? The fear of a much wider conflict breaking out in the Middle East. That's the real reason for all the anxiety gripping markets from New York all the way to Mumbai. This isn't just some regional issue, it's gone global. So this brings us to the big question for every single Indian investor. How is this conflict actually going to impact your portfolio? Because this isn't just a headline you read and forget. It has real, tangible effects on your money. We're going to connect the dots and give you the clarity you need to navigate all this uncertainty. Okay, so first things first, let's understand the trigger. What exactly happened to set this whole thing in motion? This slide right here illustrates the cause and effect perfectly. I mean, look, on the left, you see the geopolitical fault lines, clear as day. And on the right, the immediate market reaction, a pretty significant drop in the Nifty. There's a direct line connecting that geopolitical tension to all this market turmoil. The spark was a series of joint strikes by the US and Israel on targets inside Iran. And as you can see from this headline, the action was immediately condemned by major world powers like Russia and China, which, just instantly cranked up global tensions. And Iran's response? It was swift and it was severe. They didn't just put out a statement, they took a really drastic action with huge economic consequences. The complete closure of the Strait of Hormuz. Now that is a move that sends shockwaves across the entire global economy. So now let's trace the first big ripple effect of this crisis. The closure of the Strait of Hormuz, well, it immediately created an oil shockwave. We're about to see just how crucial this one little waterway is for India's economy. So what exactly is the Strait of Hormuz? Well, it's a pretty narrow waterway, but it's arguably the most important oil artery in the entire world. A huge portion of global oil supplies has to pass through this single choke point, which makes it a critical vulnerability in the global energy supply chain. And for India, this number is just critical. A full 50% of all the crude oil India imports comes right through this now blocked strait. That's a staggering amount of our energy supply that's suddenly cut off from its main route. Okay, now combine that with this next number. India imports 85% of its total oil needs. So this heavy reliance on foreign oil, it makes our economy extremely vulnerable to supply shocks, just like this one. The laws of supply and demand, they are swift and they are unforgiving. When you choke off a major supply route like this, the price of whatever's in it just skyrockets. And that is exactly what we are seeing with crude oil. This chart shows us where we are right now and where we could be heading. Brent crude has already jumped to nearly $73 a barrel, but the really critical number that all the analysts are watching is that $80 mark. If prices break through and stay above that level, it could seriously damage India's economy. Okay, so high oil prices are bad for the economy. What's the next logical step? Well, that bad news hits the stock market. So let's look at the direct impact this is having on the Nifty. Yeah, the forecast for the week ahead is looking pretty grim. Analysts are predicting a sharp gap-down opening. The really crucial level to watch is 25,000 on the Nifty 50. If the index breaks below that support level, we could see a much, much deeper slide. And right here, this is the proof that global sentiment has already gone sour. This is the net outflow from foreign institutional investors on Friday alone. They pulled out over 7,500 crore rupees in a single day. That shows you that the big institutional money is getting nervous and it's heading for the exits. But what's really interesting is that not all sectors are affected equally. You can see on the left, you've got the sectors getting hit the hardest. Aviation companies, right? They're facing higher fuel costs. Paint and tire companies, their raw material costs are soaring because they're directly linked to crude oil. And the IT sector, well, it often suffers when foreign investors pull out. But then on the right, some sectors are actually resilient, or they might even benefit. Defense stocks, they tend to rise with geopolitical conflict. Oil exploration companies get higher prices for their product. And of course, gold-related firms, they thrive in this kind of environment. So, if money is flowing out of stocks, where is it going? Well, this is a classic flight to safety, where investors basically dump their risky assets and run towards things that hold their value in terms of chaos. And the ultimate safe haven, as it's been for centuries, is gold. Why? Because it's a physical asset, right? It's seen as a universal store of value that isn't tied to any single government's decisions. You can see the price chart is just surging upwards. When fear and uncertainty take over, investors flock to gold, and that is exactly what we are seeing now. Its price has already crossed the 160,000 mark.
And in extreme scenarios, if this conflict gets worse, just look at these projections. Experts are suggesting gold could move towards 2 lakh rupees per ton grams. And silver, it could see a massive surge too, potentially hitting 3 lakh rupees per kilo right here in India.
Okay, so that is a lot of turmoil. So the really crucial point is, what should you, the investor, actually do right now? Let's walk through a clear 3-step strategy based on what the experts are advising. But hey, before we dive into that 3-step strategy, there is one more key indicator you should be watching very closely: the rupee. In times of global uncertainty, the US dollar typically gets stronger, which puts a lot of pressure on currencies like ours. This is another headwind for the Indian economy that you really need to be aware of. All right, here it is, step 1, and this is probably the most important piece of advice: avoid panic selling. Seriously, knee-jerk reactions are almost always costly in the long run. Step 2, keep a close watch on those key indicators we just talked about: the Nifty at 25,000, Brent crude at $80, and the rupee's movement against the dollar. And step 3, consider a temporary strategic diversification into assets like gold or safe liquid funds, just until this current volatility calms down. And this quote right here really helps put it all in perspective. History shows us that shocks like this typically cause these short, sharp corrections in the market. And for investors with a long-term view, these dips can actually be fantastic buying opportunities once the panic finally subsides. Which really leaves us with a final crucial question. This isn't the first geopolitical shock, and it certainly won't be the last. So the real challenge for every single one of us as investors is this: how do you move beyond just reacting to crises and start building a portfolio that is genuinely geopolitics-proof? That is a question worth thinking about as you navigate these turbulent waters ahead.